Hello students, welcome to EPG Pathshala. I am Dr. Sanjeev Sharma from Government College Nadon, Himachal Pradesh. Today we are going to talk on module Valuation of Goodwill, Need and Methods from the paper Accounting and Financial Analysis. After studying the module, students may able to understand circumstances where it may be necessary to value goodwill. Various methods advocated for the valuation of goodwill. Explain the difference between average profit and super profit, average profit and weighted average profit. As such, there is no accurate formula laid down for the measurement of the value of goodwill because the value of goodwill vary from firm to firm and depends upon nature of particular business and the circumstances connected with that business. Various methods are advocated for valuation of goodwill. In many cases, the methods adopted is purely arbitrary and is often governed by the custom of particular trade in which the business is engaged. The value of goodwill depends upon many factors such as nature of the business, circumstances connected with that business. Methods used for valuation of goodwill. There are various methods which are used for valuation of goodwill. Some of methods which are more used for valuation of goodwill are average profit method, weighted average profit method, super profit method, and capitalization method. The various methods used for valuation of goodwill are shown in this figure. These methods are average profit method, weighted average profit method, super profit method, and capitalization method. It is clear from the figure that two methods, average profit method and weighted average profit method, are based upon average profit, whereas super profit method is based upon super profit. Super profit means the profit above normal profit a firm is going to or expected to earn, whereas capitalization method is based upon both average profit and super profit. Average profit method. Under this method of average profit, for the measurement of goodwill, the average profit of given number of past years is calculated and then it is multiplied by an agreed number is considered to be the value of goodwill. It means value of goodwill is calculated by multiplying average profit with number of years purchase. Average profit is calculated by dividing total profit by the number of years of profit. This method is purely arbitrary and will frequently produce figure for goodwill out of all proportion to its value. Various steps has to be taken for calculating goodwill under average profit method. These steps are divided into 5 parts. The first step is to calculate adjusted past profits for each of the relevant year after making past adjustment. It means first of all we have to make past adjustments in past profits. After that, calculate total profit by adding each relevant year's adjusted past profits. In third step, average profit is calculated by the formula total profit divided by number of relevant years. After that, average future maintainable profits is calculated. This is calculated after making future adjustments. Lastly, goodwill is calculated by multiplying average future maintainable profit with number of years purchased. So, goodwill is calculated with the help of 5 steps in this method. Firstly, adjusted past profits are calculated, then total profit is calculated, then average profit is determined, then future maintainable profit is calculated, and lastly, by multiplying average future maintainable profit with number of years purchase, goodwill is calculated. Because this profit is based upon average profit, that's why this formula is called average profit method. In present slide, the formula of average profit is given. It is calculated by dividing total profit for all years divided by number of years. Now, what are the different merits of average profit method? This method is simple method. It is easy to calculate goodwill under this method. Further, more reliable method, and it is very much suitable method in case partner retires or expires. These are the merits of average profit method, and these are given in this figure, that this method is simple, reliable and suitable in cases when partner retires or expires. Why average profit method is preferred? What are the different merits of average profit method? The merits are simple method. This is one of the simple method and it is very easy to understand and apply it. More reliable. Average profit method is more reliable than 1 year's profit to know the future earning capacity of the business. Partner retires or expires. Generally, this method is adopted when in a organization a partner retires or expires. Demerits of average profit method are shown in this figure. This method is restricted. Restricted means restricted to profit only. It doesn't take into care assets of the firm. It is only restricted to profits. Further, capital employed is ignored. How much capital is employed in the business, that is ignored under this method. Further, this method is based upon number of years. Now, there is uncertainty regarding the number of years. How much number of years should be taken? There is uncertainty regarding the number of years. Demerits of average profit method. The first demerit is restricted. This method is restricted only up to the value of profits to ascertain the value of goodwill. Capital employed ignored. Capital employed, which is an important factor affecting the value of goodwill, is completely ignored in average profit method. Uncertainty regarding the number of years. There is uncertainty regarding the number of years for finding out the average profit and the number of years purchase. Therefore, results arrived are far from satisfactory. Concept of number of years purchase. Now, what is the logic for multiplication of average profit with number of year purchase? It seems to be that the new partner has compensated the old partner for assured profits. The period of time for which the profits are assured to new partner is called number of years purchase. It is important to note that number of years purchase is based purely on approximation rather than on scientific basis. It means number of years are just estimation. These are not calculated on some scientific basis. Let us understand the concept of average profit. Goodwill simply means good reputation of firm is linked with profits. In case the firm earn more profit, there will be more goodwill. But if profits are less, the amount of goodwill will also less. The profits are not earned by business uniformly because business pass through different stages which have effect on earning capacity of the business. This figure shows that goodwill is linked with profits, and if in case the firm earn more profits than other firm, there will be more goodwill, and if the profits are less, the amount of goodwill will also be less. So when the valuation of goodwill is done, why profits are taken as base? This provides the answer of this question, that goodwill is definitely based upon profits, and if firms are earning more profit, there will be more goodwill of that firm. If firms are earning less profit, the goodwill will also less. During the adverse situations, the profits are decreased, whereas during the favorable situations, profits are sharply increased. Therefore, in order to set right all the fluctuations and to ensure better results, the concept of average profit is preferred. While calculating goodwill, average profit is taken, not profit for a particular year, but average profit is taken. Example for calculating goodwill with the help of average profit is given here. Gupta and Verma agreed to value goodwill at 3 years purchase of the average profit of the last year for admitting John as a partner. Profit for last 5 years are: first year rupees 20,000, second year 15,000, third year 17,000, fourth year 23,000, fifth year 18,000. Now we have to calculate the value of goodwill, and this information provides that the goodwill will be 3-year purchase of average profit. Valuation of goodwill is given in this slide, and first of all, total profit is calculated by adding profit of first, second, third, fourth and fifth year, that is 20,000 plus 15,000 plus 17,000 plus 23,000 plus 18,000, and the total profits are 93,000. With the help of total profit, average profit is calculated, and the formula for average profit is total profit divided by number of years, and there are 5 years. So for calculating average profit, 93,000 is divided by 5 and average profit comes to 18,600. Now the value of goodwill is equal to average profit multiplied by number of year purchase, and number of year purchase is given 3. So 18,600 is multiplied by 3 and value of goodwill is 55,800. So it is clear from the example that the value of goodwill is calculated with the help of average profit and number of years purchased. And how average profit is calculated? It is calculated with the help of total profit and dividing that total profit with number of years given. Now, what is the meaning of abnormal items? The profit which are not earned during the normal course of business are called abnormal profits. The abnormal profit calculated as per profit and loss account should be clearly scrutinized. There are certain items which are to be added and some items should be deducted while calculating the normal profit. So it is necessary to understand the meaning of abnormal items or abnormal profit, and simply the abnormal profit is that profit which is not earned during the normal course of business. Let us understand various items, those should be deducted from the profits. These items include abnormal profits or extraordinary gains which are credited to profit and loss account. For example, abnormal profits or extraordinary gains include, for example, profit on sale of assets, profit on sale of manufacturing license. These items should be deducted from profit because these are abnormal in nature. These are not generated from normal activity of the business. Further, future expenses and provisions likely to be incurred in future. The expenses and provisions which are likely to be incurred in future or future expenses and provision should be deducted from the profit. For example, provision for doubtful debts, additional depreciation, etc. This figure shows that items to be deducted from profit. Abnormal profits or extraordinary gains should be deducted from profit. Further, expenses likely to occur in future should also be deducted from profit while calculating profit for the purpose of valuation of goodwill. So these profit, abnormal profits or extraordinary gains, these arise due to abnormal reasons or not due to normal course of business. That's why these are deducted from the profit. Now, it is important to have the knowledge of the items that should be added in the profits. Some of items such as revenue likely to accrue in future from pending contract. If revenue is likely to accrue in future due to pending contract, it should be added back to the profit. Further, abnormal losses or extraordinary losses, the losses which are generated due to abnormal reasons should and debited to profit and loss account, these should be added back to the profit. Further, expenses debited to profit and loss account but not likely to occur in future. These should also be added back to profit. Items that to be added in profits are shown in this figure. This figure shows that revenue that is likely to occur in future are shown or added in profit, whereas future expenses and provisions which are not likely to occur in future should be added back to the profit for the purpose of calculating true profit or fair profit or calculating the goodwill. Now, let us define the meaning of weighted average profit method. This is modified method of year's purchase of average profit. It is the modification of average profit method. Simply we can say that it is modification of average profit method. This method is applicable particularly in the rising trend of profit. When there is rising trend in profit, then this method is suitable method. Under this method, each year's profit is multiplied by the respective number of weights, that is 1, 2, 3, 4, etc. in order to find out the value of product. The sum of product is then divided by the total weights to get the weighted average profit. The weighted profit is then multiplied by the number of years purchased. It is clear from the figure that while calculating goodwill under weighted average profit method, 5 steps are taken. In step 1, product for each year is calculated. Product means profit multiplied by weight of respective year. In step 2, aggregate of the weights is done. In step 3, aggregate of the products is done. In step 4, average weighted profit is calculated with the help of formula, that is total product of profits calculated in step 3 divided by total weight calculated in step 2. Lastly, goodwill is calculated with the help of formula weighted average profit multiplied by number of years purchase. What is the difference between average profit and weighted average profit? It is shown in the present figure. The average profit method. In average profit method, product need to be calculated. There is no need of calculating product under average profit method, whereas it is mandatory to calculate product under weighted profit method. So simply, product is required in weighted profit method. Weights. In average profit method, there is no use of weights, whereas weights are calculated in weighted average profit method. Time of use. Average profit method can be used in any situation, whereas weighted profit method can used particularly in rising trend of profit. When there is rising trend of profit, the appropriate method will be weighted average profit method. So simply there are main 3 difference: product, which is required in weighted average profit method; weight, which is also required in weighted average profit method. For the average profit method can be used in any situation. The weighted average profit method is suitable only in case of rising trends of profit. Now let us understand the meaning of super profit method. If a business earns profit in a normal course more than what the other business are earning in the same trade, then it means that business has some superiority over other business. Such superiority is due to super profits. Super profit refers to the excess of actual profit over normal profit. Normal profit refers to the profit which the firm could reasonably or normally earns in a particular business. It is calculated by multiplying normal rate of return with capital employed. Simply the formula is normal profits is equal to normal rate of return multiplied by capital employed divided by 100. Steps of calculating goodwill by super profit method are shown here. Firstly, average capital employed is calculated. Then in step 2, normal profit is calculated or determined by multiplying average capital employed with the normal rate of return. In next step, average future maintainable profits are calculated. In fourth step, super profits is calculated with the formula average maintainable profits minus normal profits. Lastly, the goodwill is calculated by multiplying super profit with number of years purchase. There is a difference between average profit and super profit. Now let us discuss the difference between average profit and super profit. Now first difference is capital employed. Capital employed is not used or not required for calculation of average profit, whereas it is required for calculation of super profit. Normal profit. Normal profit is not calculated when goodwill is calculated with the help of average profit method. But when goodwill is calculated with the help of super profit method, normal profit is always required. Profit for number of years. Profit for more than 1 year is required to get figure of average profit, whereas only 1 year actual profit is required in case of super profit. Normal rate of return. It is not required in average profit, whereas without normal rate of return, super profit cannot be determined. What is the formula of average profit? Total profit divided by number of years, whereas super profit is calculated with the formula actual profit minus normal profit. So it shows that while calculating super profit, we need capital employed, normal profit, normal rate of return, whereas all these three are not required for calculating average profit. Now, capitalization method. Under capitalization method, the goodwill may be calculated by two ways. The first, capitalization of super profits. Second is capitalization of average profits. Capitalization method is shown in this figure. It shows that on the basis of capitalization method, goodwill is calculated, and it can be calculated with the help of super profit or average profit. It means it can be calculated with the help of super profit and also with the help of average profit. Capitalization of super profits. The value of goodwill is taken to be an amount which, if invested at normal rate of return in business of similar nature, would give an yield equal to super profit. In other words, the value of goodwill is obtained by capitalizing the super profit on the basis of normal rate of return. The formula of goodwill under this method is super profit multiplied by 100 divided by normal rate of return. Example for calculating goodwill is given here. A firm earned net profit during last 5 years. First year 7,000, second year 6,500, third year 8,000, fourth year 7,500 and fifth year 6,000. The capital investment of the firm is 40,000. Normal rate of return is 12%, and goodwill is to be calculated on 3-year purchase. Valuation of goodwill is done here. The total profit for 5 years is 7,000 plus 6,500, 8,000 plus 7,500 plus 6,000, that is 35,000. And the average profit is 35,000 divided by 5, that is 7,000. Normal profit is equal to capital employed multiplied by normal rate of return, that is 40,000 multiplied by 12%, that is 4,800. And the super profit is average profit minus normal profit. Average profit is 7,000, normal profit is 4,800. That means super profit is 2,200. Now the goodwill is equal to 3-year purchase of super profit. That means goodwill is equal to 2,200 multiplied by 3, 6,600. Capitalization of average profit. Another method of valuation of goodwill is capitalization of average profit. As per this method, average profit are capitalized on the basis of normal rate of return. The figure ascertained is known as value of business. From this, the net assets of business is deducted. The balance come out is called goodwill. Steps for calculating goodwill under capitalization method are given here. In first step, capitalized value of business, average adjusted profit multiplied by 100 divided by normal rate. In second step, capital employed, that is total assets excluding goodwill and less outside liabilities is calculated. In third step, capitalized value of business less net amount of assets, that is capital employed, as per second step, and with the help of this goodwill is calculated. It is important to note that in case capital employed is more than the amount of capitalized value of business, there will be no goodwill. So students, let us now summarize what we have learnt in this module. Aggregate of actual profits earned divided by number of years give average profit. Average profit method are more reliable than 1 year's profit. Average profit method is simple to understand. Super profit is one of the method to calculate goodwill. Super profit refers to the excess of actual profit over normal profit. As per capitalization method, the value of goodwill is super profit multiplied by 100 divided by normal rate of return. Capitalization of average profit are capitalized on the basis of normal rate of return and can be calculated as formula average adjusted profit multiplied by 100 divided by normal rate of return. Average profit is the average of past few years profit, whereas super profit is excess of average over normal profit. The period of time for which profits are assured to new partner is called number of years purchase. Thank you.